Inflation just hit a 10-year high. What does that mean for Vancouver housing? Hello and welcome back to the Vancouver Life Real Estate Podcast and YouTube channel. We just mentioned that inflation numbers are out for the month of April, and they actually just hit a 10-year high. This was a bit unexpected. It's a big number. For reference, we basically try to stay on track for about 2% per year, right? And so although it is measured monthly, to hit 3.4% really starts to skew things up. So this is measured by the Consumer Price Index. And yeah, like I said, it was a 10-year high just last month. In March, it was 2.2%. So it did a whole 1.2% increase in just 1 month. Now, to kind of dig a little bit deeper into this, and similar to what happened last month with housing sales, we do remember that April of 2020 was when basically the world, being Canada for us, shut down, right? That's when all the lockdowns happened and home sales stopped and were like an all-time low. And that's why, based on what happened in April of 2021, it was up 340%. So a similar thing is happening here with inflation and the CPI, the Consumer Price Index. April, it obviously lowered quite a bit. So seeing it jump 3.4% year over year is a bit understandable. Especially when you take into effect things like gasoline prices were up like 63% over last year, being April, when again, not too many people were driving and then, the flights were grounded, etc. So Bank of Canada trying to hit that 2% target, 3.4 raises some flags, but it's something that's going to be watched because it is coming off a low baseline. So the big question becomes then, is this going to remain high for the next few months and really change the outlook of what's going to happen with interest rates? Or is it going to kind of taper off and kind of become more of status quo for the rest of the year?
Oh man, difficult question to answer right now. I think his year over year stats right now. I think when you look at March, when you look at April, when you're going to look at May, they're all going to be, you got to take them all with a bit of a grain of salt here, because I think a lot of the stats in general are all going to be skewed. There was a lot going on this time last year, right? So the baselines are going to be all strange. I mean, you could probably say that, gasoline prices are up 62.5%, this April over last. I would say that toilet paper sales are down 62%, right? So I mean, it's when you look at kind of what's happened in the last year, it's been a strange year, right? So some of these stats are a little strange, but at the same time, 3.4% to me, I can believe it though. That's I think where it kind of rings a bit of an alarm bell for me. You know what I mean? We've got other ways to kind of temperature check that too. I mean, when you look at lumber, for example, sheet of plywood was $34 this time last year. It's $108 now, right? I mean, that tends to happen when inflation takes place, right? So,
Yeah, exactly. I think,
is it up?
Yeah, sorry, go ahead.
No, I was just saying, is it really up 3.4%? Is it up 3%? It's going to be difficult to tell right now because, I get that it's 2.2 in March and 3.4 in April, which is definitely a hike. But if we're looking at it as above a 10-year high, that's where it kind of, you scratch your head for sure.
I think too, the CPI for a lot of people is known to be a very, what's the good word for it? Just not a perfect science, to say it nicely, right? It's a flawed way of tracking inflation. And like you said, Ryan, it doesn't take much just to leave your house and try to buy almost anything. And it certainly feels like it costs more than 2 or 3% than it did just 1 year ago. Lumber and gas being two very obvious examples there, right? So if 3.4% is what they're saying, chances are, and oh gosh, I've even mentioned housing, right? Up 30% nationally here. So, and that's something that's not even tracked within the CPI. So realistically, yeah. So exactly. So I think the fact that they're kind of showing that it's 3.4 and everyone else is saying it feels like a hell of a lot more. Well, again, we're going to track this very closely. And, again, how this evolves over like the next 3 to 6 months will really say a lot and be very important for the stance of the monetary policy over the next year or so.
I think that's a really important point, Dan. Like the next 3 to 6 months in particular are going to be pivotal for how 2022 plays out in terms of interest rates, right? I mean, right now we've heard from the Bank of Canada that the 2023 is the target for interest rate hikes. But, if we continue on a 1% kind of a month increase here, you could expect that to happen much sooner.
That's it. And so, interestingly enough, right on the heels of that announcement of 3.4%, Tiff Macklem, the governor of the Bank of Canada, came out and made a bit of a statement, and essentially saying that, look, we're seeing these 30% appreciation rates in housing, and he wanted to make it very clear that that is not normal. He just thinks that people may be buying homes and feeling comfortable with all these over ask offers and going subject free because it looks like home prices are going to go up forever and at these astronomical rates. So he kind of, made his point heard and said, look, don't over leverage and don't overutilize these like historically low interest rates because those aren't going to be around forever. Hint, hint.
Yeah, I think it's very important for our audience to understand that the verbiage used by people like Tiff Macklem, it's very important. This is like, a warning shot across the bow. You have to take this very seriously. It's not something that you should sleep on, right? It's not just someone coming out and saying, obviously 30% is too high. He's leading into that. He's trying to warn people that if it continues doing this, the game plan's going to change, right? And that's how you should read that. You shouldn't read that any other way.
Yeah, I agree with that.
I think personally.
Yeah, no, for sure. He's not wrong, but it's also a bit of a contradictory statement from what happened just a year ago. I guess first, I'll just share a bit of numbers here of why TIFF is kind of raising these alarm bells and well too late in our opinion, I would say. But mortgages that are 450% loan to income ratio or higher, the amount of those, it actually rose to about 22% of all mortgages by the second half of 2020.
Is that a big rise, Dan?
It is a big rise, and it's currently at a record, and it is higher than it was in 2016, 2017, when we saw policies implemented, AKA the stress test. So people are clearly leveraging themselves, right? People are taking advantage of historically low rates and buying as much as they can.
It's also the whole point of it, right?
Well, that's it.
The whole point of dropping the rate is to get the stimulus going.
100%. And that's what I mean by it's a little bit contradictory for Tiff to say, because it was, a short 12 months ago when he said, we're going to pin rates to the bottom for a minimum of 2.5 years, 3 years, and go and buy stuff because we're going to make sure that you can. They knew that quantitative easing was going to result in inflated asset prices. And here we are, right? We have a successful result to what they tried to implement. And now they're saying, well, slow down. We might, people kind of got, I guess, a little out of control or used it more than they expected. And now they're trying to kind of really get in and saying, look, we got to pull back on the spending right now.
Well, when you look at when you look at CERB too, I mean, when you look at the amount of money that went into the economy, the amount of money that got printed, right? I mean, it was probably more than we've ever seen in recent history. And so, this was bound to take place. I guess, and I've said it in previous episodes, it's the messaging that they kind of got, I don't think they got right here. Especially a year ago, they were very aggressive with their tone when they came out last year saying, hey, we are going to be, pinned to the floor until 2023, right? And so people went about buying in ways that reflected that, right? And now I think I get it. They got to put the brakes on, or they at least in the next 3 to 6 months, depending on how the economy plays out, they may have to do something like that, right? Or make an announcement that will cool the economy. But I think, another thing to consider here is that these announcements will have an impact on behavior, right? So that's why they come out with them.
And granted, we were basically in a once in a lifetime uncharted territory kind of scenario. So I think, they did what they absolutely felt was right. And, we will never know what an alternative looks like. And,
Yeah.
but understandably, maybe that pendulum swung a little bit too far, maybe a bit too much QE, interest rates a bit too low, a couple of promises that were a bit too bold. So sure, reeling things in now that all the data's changed, it's understandable, but it's,
Yeah.
it's very,
That's assuming it goes on a 3 to 6 month trend in this direction too, right?
Mhm.
This is the trend I think they want to go, but it's got to sustain. So we'll see. But like you said earlier on, Dan, the next 3 to 6 months are crucial.
Yeah,
I
exactly.
really think so.
So interestingly, here we go, with sort of the next step. So the inflation 10-year high announcement comes out. Next day, Bank of Canada's warning about rates potentially rising. The day after that, being today, which is now Friday, May 21st, we learned that the sort of as expected, the new stress test proposal is going forward and is going into effect on June the 1st, which essentially takes the stress test from, was it 4.79% up to 5.25%. I think the thing that was maybe a little unexpected, though, is that this change is applying to all mortgages, even those with less than 20% down payment, who also get to pay the CMHC insurance.
And I don't think that's a bad move. I don't think that changes too much either, to be completely honest with you. The change, I think, again, in terms of who it'll affect the most, I think that change will definitely affect the lower end of the market, like we've talked about before. Those people will be affected the most by this stress test change. But even then, though, I don't think it'll be such a tremendous change that we're going to see much change in the market. I think that these are, again, more policy kind of statements to change buyer behavior and kind of cool where people's heads are at, right? And I think we'll see where it plays out.
Yeah, of course, it's going to end up being in all the headlines for the next couple of days here, likely. But ultimately, this does reduce buying power by around 4.5%. So really, don't stress about the stress test. It's not going to change things too radically. I did a little bit of intel though here because I was curious. When people apply for their mortgage, they get approved for X amount, and I thought, how many people out there are going out and buying at their absolute max, right? Let's say you're approved for $1 million. How many people are buying at $1 million compared to those that are buying for less, 800, 700, whatever that number is? One very high profile mortgage specialist that we work with a lot said it's about 85% of his book buy at the absolute peak of their buying power.
Affordability. Wow.
Yeah. So
Well,
that plays into two things too. That plays into, what Tiff is saying about don't over leverage, and yes, this is with stress tests already in place. So there is some buffer and safety net there. But then two, it does say that, look, maybe that 4.5% will actually apply to the majority of new home buyers, which will ultimately result in a bit of a softening in prices.
Interesting.
Yeah, I was actually surprised.
I can actually yeah, I mean that 85% number, that's a really important piece of data, right? And I mean, the one thing that tells me, it also speaks to the unaffordability element of living in Vancouver, right? The fact that property here is so expensive, so it doesn't surprise me per se. But it is a higher number than I thought it would have been.
Yeah, same. Yeah,
that's
people are
interesting, and it's a bit of a something to pay attention to.
For sure. Because yeah, even though the banks do have stress tests in place and we are being protected from ourselves, and yes, the arrears rate is almost at all-time low. And yes, the all-time low was even lower when interest rates were much higher, 18, 20%. And we actually saw a arrears rate that was lower than it is today. So other levers can be pulled, right? So know that as interest rates do rise in the future, that's not going to be the do all and end all that determines pricing, because other things can be done to affect it both up and down.
Hmm. Okay, well, let's get away from some of that scary stuff. And let's talk maybe a little bit about some reality here, about maybe the next 3 to 6 months in terms of what's going to happen and how we think maybe those months are going to play out in terms of the economy as a whole. Because I think as inoculations continue to go, we're looking at open borders coming soon, and I think that that could be a bit of a game changer, right? I mean, Canada is, as we know, has a huge and very aggressive immigration policy. You're looking at between 1.3 and 1.5 million people every 3 years, right? In terms of new permanent residents. So those immigration levels are expected to soar, right? And I think that will have a huge impact on the housing side of things too.
Well, of course.
It has to, right?
Tourism's about to come back. Restaurants, I
Yeah,
think we just heard are actually allowed to reopen on Tuesday for indoor dining. That's going to change everything.
amazing.
The universities are going to open up again. International students will be coming back again. Yeah, this is going to change. I think it's going to happen very quickly. And as we touched on, on a number of earlier episodes, a lot of Canadians are sitting on more savings than they've ever had. And they're likely itching to spend some of that. And when you can travel, you probably will. When you can dine out again and enjoy yourself, a lot of people likely will. So, when you're talking about the economy, Ryan, I think we're going to see a huge injection of money spent and a spike in the economic fundamentals there.
Could be like another Roaring '20s, at least for
It
a
has
short
been
little while.
predicted. That's it. Yeah.
Yeah.
Yeah. until those curb dollars are spent. But at the end of the day, it's a very potential outcome of what can happen here in the next, like you said, 3 to 6 months, and then what happens when the economy takes off.
Yeah, I mean, at that point, you're going to see inflation get another bump. Another bump. It's going to have a lot of pressure again, and you're going to see interest rate controlling. It's going to be an interesting time for sure. But I'm excited for the economy to come back. I think that's, oh boy, do we ever need that.
Yeah. You know what else we need apparently is more homes.
Yeah, nice segue.
Yeah, thanks. So, very interesting article that we came across, and a bit of an eye opener when you sort of hear it related to other countries. Not really a surprise, but when you've got factual data to kind of quantify what you've been sort of hearing and feeling going on out there, it does exemplify sort of what we've been talking about, and leads into or lends to why housing is so tight in Canada and why prices continue to go up. And essentially, the headline there is that Canada has the lowest number of homes per capita of any G7 country.
Wow. So, okay, tell me how many homes per, what's the number?
Yeah. Okay. So the average for your G7 countries is 471 homes per every 1,000 people. And
Right.
Canada is well below that at 424 homes per 1,000 people.
Interesting. Wow.
So
So what would that?
Yeah, I guess, while maybe the 47 home difference, maybe it doesn't sound that different or that much lower. Well, think of it like this. Canada right now, today, would need to build another 1.8 million homes just to equal the G7 average. That's a big number.
Sorry, I shouldn't laugh. That's a big problem, but it's so ridiculously out of whack that there's just no way we could ever build anything like that in one year, or even, God, it would probably take 10 years.
Yeah, I mean, well, this
It
year
would take a long time. I mean,
well, for sure. I mean, you got to think this year Canada's on track, which is for like a record number of housing starts at like 280,000.
wow. There you
So
go.
now, if 0 new people entered the country, whether it's from birth or immigration or anything, if 0 new people came to Canada, it would take 6.5 years of building at this record pace just to equal the average of the rest of the G7 countries.
Wow. So my joke of 10 years really wasn't off.
Yeah. Well, this is the thing, right? We're now trying to get record immigration into Canada of 400 plus thousand people
Yeah.
per year and growing every year. So the discrepancy is going to take a long time to catch up. Let's just say that.
Mm.
And again, we've touched on previous episodes, it sounds like this is by design, right? This is on purpose.
Yeah, it has to be. I mean, it's the only way you continue to keep interest rates low, grow the economy. You got to bring people into your economy in order to keep that sort of equation moving, right?
Mm-hmm.
It's if you're going to continue pushing price on something that has supply and demand, you have to have more demand than supply. So this speaks to that, right?
Mm-hmm.
It
Yeah.
certainly feels like it to me. You know, I mean, we've got a note here that says that there is 2.7 people per every home in Canada right now.
Yeah.
There's
That's it.
that's crazy.
Yeah.
That's crazy.
And then you got to think too, with these 400,000 immigrant target that they have for even this year, which they're still trying to stick to, even though we're halfway through the year almost, that's another 148,000 homes needed just to maintain status quo, which is well below average.
Well, and interestingly, so that kind of speaks and is really actually a good entry into our next piece, which is a little bit of a follow-up on last week, because last week we talked about the median and average price of homes, and I believe that they were down by about 60,000 at the start of the month. It was around 60,000, right, Dan?
Yeah, we definitely struck a nerve with this last video where we talked about home prices going down in Vancouver, which again, looking at the median and average, they are going down for the first time really in about 20 months. And yeah, Ryan, you're right. Median price was down like $53,000 just last week, right?
Yeah.
So the first 2 weeks in May. We definitely thought we'd follow up because I'm sure everyone's curious where it's gone now because things are clearly moving quickly. It has recovered a little bit of that price decrease. The median this week is now down $37,000. So still down.
Yeah, but that's much better recovery though.
Right.
So it's a
Yeah.
bit, I mean, yeah, but I mean, you're going to come, last month was, well, the month before last month was all-time highs, right? So we're just coming off of all-time highs. So, and like we talked about, the foot is coming off the accelerator. We're not seeing, a massive shift in the market or anything like that. We have noticed that the market is cooling. And this speaks to that. We didn't talk about it dropping, right? So, the cooling effect is taking a place. And I'm actually quite happy to see that we've had a little bit of price recovery from where we were at the start of the month. I think it's a bit more sustainable on that rate to continue, right?
Yeah. I mean, it was down 6% in the first 2 weeks, and that's a little bit too much. We don't want to see it drop off
Yeah.
that quickly because, again, just like people maybe made some irrational decisions when it was going up too fast, people may do the same when it goes down too fast. So,
good point.
yeah. And then average last week was down about $41,000 in the first 2 weeks of May. That's now down about $28,000 for 3 weeks of May. So still down, not down as much as 2 weeks ago or 1 week ago rather. And we've got 5 trading days left in the month. So we are going to end up down for the month of May, both median and average prices. HPI, again, lagging indicator, it will show up higher a little bit for probably a month or two more. But again, median and average is telling the story, and especially that sales to active listings ratio, which don't have an update for you this week, but it was really down last week. And it's one that seems to really dictate future prices quite accurately.
Yeah, and I think if we just speak anecdotally for a second about maybe the last couple of weeks in real estate, it's been cooler. That being said, though, property that is well priced, not property that is even aggressively priced, or property that is outrageously priced is a different question. But aggressively priced and priced to market, we are still seeing a ton of activity. A lot of people moving into these properties, and that's from the 500K kind of up to the 1.6, 1.7 range. It's still pretty bananas in many different areas. But like we said, there's just more supply right now. So there's a little, buyers are a bit more spread out, and the pace is off a little bit, which generally speaking for buyers is a good thing.
There you go. That's where things are trending right now. So everyone, I think that wraps it up for us today. Thank you always so much for watching and listening. We really appreciate everyone who is subscribing. So please join this video. The last one really kind of did some fascinating numbers that we're super thankful for, and YouTube started promoting us a bit there. And that's thanks to people like you that are subscribing. So please keep that up, and we'll continue to do everything we can to bring you incredibly timely and important Vancouver real estate information.
Okay, guys, we'll see you next week.